You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan, today. Today, we're going to talk about the ultimate short-term rental tax strategy podcast. So year to date, my number one episode has been the short-term rental tax loophole. And if you haven't checked that out yet and you're not familiar with this strategy and you're a real estate investor, I highly recommend that you check it out and watch it. It was published on April 11th. And I also have an episode on June 13th that talks about real estate professional status. And the reason why this is so important is because as a real estate investor, you really want to understand the differences between the two because it's going to impact your type of investing, right? If you're investing in long-term rentals or commercial property, you're going to need to be a real estate professional. If you're investing in short-term rentals, you're going to want to watch this podcast. Okay, so we talked about why short-term rentals are the best type of real estate investment. It's because you're able to have a W-2, you're able to own a business like me, and you're still able to harness a lot of the tax benefits that come with owning rental real estate. Let's be very clear. We're not buying rental real estate solely based on the tax benefits. However, those tax benefits can be tens of thousands, if not hundreds of thousands of dollars per year, and can certainly boost your bottom line. We're going to talk about how to qualify. So again, if you haven't already, make sure you go back, check out that other podcast. I break down the specifics, but we're just going to wrap it up here today. I want to spend time talking about how to qualify. Remember, you need to purchase a property and place it into service as a short-term rental. Well, what does a short-term rental mean? Well, it has to be an average guest stay of 7 days or less. So if you add up the total amount of days on Airbnb or Vrbo or direct booking and you divide it by the number of unique stays, that has to be 7.0 or less, right? So if I have 150 days total rented and I have, let's say, I have 10 or 15 stays, I would be able to do the math. And if it's 7.0 or less, that's going to qualify. Second, you need to perform a cost segregation study, right? You need to be able to extract out the depreciation that's on that property in order to be able to take it against your income. And most importantly, you have to do what's called materially participate, which means you have to be the one that's self-managing the property, that's putting in more work than anybody else. So you have to prove those hours requirements. Again, we talked about it in one of the previous episodes, but just to recap, it's normally going to be you have to spend at least 100 hours and your time is more than anyone else. So if you have a cleaner, a contractor, a handyman, somebody else that's doing work on your property, you have to prove that you spent at least 100 hours and more time than anyone else. If you're not able to prove material participation, it's not the end of the world because remember, real estate is a passive activity. And so passive activity gains can always be offset with passive activity losses. So I see this a lot with clients where they'll have 2 or 3 long-term rentals, everything's going fine, but they're like, you know what? We really want to harness more cash flow in our properties. Our long-term rentals are only making us $300-400 a month. We want to be able to buy short-term rentals, right? Well, you're going to be able to generate a loss on that short-term rental. In worst case scenario, use that loss to offset your other rental property income. Maybe you have a big sale that year. Maybe you sell off one of your long-term rentals and you're not able to 1031 exchange. You can buy a property, place it into service before the end of the year, accelerate the depreciation on it, and use the loss to offset your gain. Why is it so powerful, right? So for someone in a 32% tax bracket, so that's a single person making up to $215,000 per year, if they had $50,000 worth of depreciation, they would save $16,000 in federal income tax. $100,000 worth of depreciation would save that same person $27,000 in tax savings. So think about this, right? You're buying your, first short-term rental, it's $400,000, $500,000, and you're able to generate $100,000 of depreciation, which on the back end is going to generate you $27,000 in tax savings. You're able to plug that $27,000 into your bottom line. Why is it so powerful is because we've already spent the biggest portion of that purchase in the form of our down payment. And now it's about like, how do we get that down payment out and turn that into tax savings? And that's through accelerating the depreciation. Accelerating the depreciation will accelerate your wealth building journey. And we've talked about this before. Even if you go back to one of my more recent podcasts that talks about leverage in real estate, how do you accelerate that wealth building journey? And again, maybe you don't want to accelerate it. Maybe you want to take your time. But for those who are trying to straight path their way to FIRE and be financially independent, you need to use tax strategy to accelerate your wealth building. So what should you look for in a short-term rental from a tax perspective? I haven't really covered this yet. Some of my clients get this, but I haven't really covered this in long-form podcasts. When you're investing, you want to find areas that have high building value and little to no land value. And the reason being is because you're not able to depreciate the portion of the building that is considered land. So if I had a $500,000 purchase, but let's say only 80% was building, I'm only able to depreciate on that $400,000, not the entire purchase price. So we want to find areas that have high building value. And the way you do this is before you even purchase a property, you can go on the county assessor website. So this is going to be specific to where you're investing, and you can research, hey, this property, how much is the value, how much of the value is being assigned to the building and how much of it is being assigned to the land. And as an investor, you're going to want to do this anyway when it comes to tax reassessments. If you see a property that, let's say, 2019, 2020, the tax bill was $4,000. Well, when you go to buy that property in 2022, the tax bill is going to jump because the sale will always trigger reassessment. So you're going to want to do that for your pro forma anyway. You might as well loop in the tax benefits of the property. Newer properties will tend to have more depreciation, and that's because the components of these newer buildings, let's say anything built after 1990, compared to a house that's over 80 years old, newer properties are going to have newer components and structure and different framing and even the framing in the houses, so they're going to warrant more depreciation. And I would say, lastly, is look at condos and townhomes where they don't own any of the land that the building sits on. And so ideally, a condo or a townhome sometimes can have no land at all, which are most ideal for tax perspectives. If you want to do a general rule of thumb, stay away from the ocean as much as you can. So your Florida, your Destin, 30A, even Southern Texas, California, those areas are going to have high amount of land value most of the time. Again, you can know this by going on the county assessor website and seeing for yourself. So some of the advanced strategies, and we haven't really covered this yet, but I wanted to talk about it, is when the market is in a downturn. Okay, when bookings are down, people are not getting the revenue that they thought they were. They still have utility bills, they still have mortgage payments to make, they still have people to feed. One of the things you can do in order to generate cash flow is to harness the tax benefits that are already trapped inside of your property, right? Taking that accelerated depreciation against your income will drop your tax bracket, which will allow you to do other cool wealth building strategies. So one of the things that comes to mind the most for me is if I can take a client from, let's say, so understanding the marginal tax brackets is important because we have a 10, a 12% bracket. And then as a single person, I believe once you make more than 50,000 or so, you jump up to the 22%. And then it's 22, 24, and then it goes from 24 up to 32. So you see where there's these big jumps, right? 12 to 22 is a 10% increase, and then 24 to 32 is where the real big increase happens, where we really want to plan around that sort of increase. And what happens is you take a taxpayer, let's say they're in a 32% tax bracket, and they're able to accelerate the depreciation. Oftentimes, they're able to go from a 32% tax bracket down to maybe 22, right? Or 24, or maybe even 12. And that allows for other planning opportunities, such as a Roth conversion. So maybe you had money that's sitting in a traditional 401k or an IRA that hasn't been taxed yet. Well, in years of lower income, you want to convert that money over to Roth because you could be saving hundreds of thousands of dollars over time because now that money is never going to be taxed again once it's in a Roth account. So I'm taking my income from a 32% bracket, down to, let's say, a 22 or even a 12 or a 12, right? And I'm also doing Roth conversion strategies. Or maybe I'm contributing to my Roth 401k instead of a traditional 401k. Because now, if I'm contributing to a traditional 401k at a 12% bracket, I'm getting less savings than if I was to contribute that at a 32% bracket. And if you go back and watch some of my podcasts on the Roth IRA, I always mention, hey, if your marginal tax bracket, so you add up your Fed and your state, is over 28%, it really makes sense to go traditional. If it's below 28%, you really should be going Roth. And using short-term rental tax strategy allows you to push your tax bracket low so you can utilize these Roth conversions or Roth contributions. One of the things too is your income also sets the standard for your long-term capital gains bracket. And so as a married couple, if you make less than $123,000 a year, your long-term capital gains are tax-free up to that amount. So you could have a scenario where you buy a short-term rental, you're able to significantly reduce your W-2 income, and it's going to also allow you to capitalize on selling some of your other assets, or again, like I said, contributing to Roth accounts. The last strategy that we'll talk about is withholding. So what happens is, let's say you make $200,000 as a W-2. Okay, so let's say you're paying $50,000 in taxes. Okay, let's say you have a short-term rental. So then you're able to cut your income from $200,000 down to, let's say, $100,000, and now your tax is only $20,000. So you go from $40,000 tax liability projected to $20,000. Well, what are you able to do? If you do nothing, you're going to get a refund check on April 15th of the following year for that difference, for your tax savings. If somebody wants to free up cash flow, especially in times like now where bookings are down, they're able to just not withhold federal income tax on their W-2. So maybe you tell your employer, hey, I want to go exempt, or you file for more dependents. You're able to tap into those tax savings right away rather than having to wait until April 15th. And I think that's super important. Again, in times like now where people are trying to free up cash flow, that's a great strategy and a great method. Just know that come April 15th, you're not going to get that big refund that you thought you were going to get. So I wanted to first, I guess I'll talk about some things to consider or watch out for, and then we'll go into a real life example of kind of how this works. So like we said before, right now is a great time to looking into harnessing those tax benefits when it comes to real estate. Because bookings are down, the economy is looming, sort of recession, sort of not. It's a great time to free up some cash flow that you need. More importantly, bonus depreciation right now in 2022 is at 100%. For properties placed into service in 2023 or later, it's going to start at 80%. So placing the property into service this year before the end of the year versus next year, you're talking about a 20% decrease. Now, for some people, your high earners, it's not going to matter. People are still going to be doing bonus depreciation next year, even if it's at 80%. There are tons of cool strategies that you can implement that by lowering your bracket, you're able to do other creative strategies. You're able to, again, contribute to those Roth IRAs or those Roth 401ks at lower tax brackets. Harness long-term capital gains now that you're at a lower tax rate. So we're going to talk about, on my website at learnlikeacpa.com, if you go to shop, there's a cart. You can buy my short-term rental calculator. Not buy, it's free. But you can access my short-term rental calculator, and I'm going to do a demo here. This is a recent deal that I was running. So it's very simple, guys. So I have little instructional videos on the left here. And so if you can't follow along, just let me know. You'll be able to watch those videos. But this particular property, you type in your acquisition cost, your staging cost, your projected income, what you think you're going to make on the property, your financing, etc., and it will show you your investor metrics. So this particular deal, the cash-on-cash return is 60%. We have a debt service coverage ratio of 4.5, a cap rate at 27%, and a payback period of 1.66. I haven't talked about the payback period before, but the payback period is how quickly are you getting your cash out of that deal so you can put it into the next one. Sometimes it's known as turnover time in accounting. But here at the bottom, I have the tax benefits portion. And with this, you're able to plug in your filing status, whether you're single or married, your W-2 income or your business income, the total amount of rental income that you're expecting to receive that year, and it will show you what are your tax benefits. So this particular deal, because this $360,000 property is going to save me $28,000 in tax, I'm able to take that $28,000 of tax savings, plug it into my net operating income, and it boosts my cash on cash from 60% up to 83%. So you can see how tapping into those tax savings can boost your cash on cash return and free up cash flow for you for that year, because that's money that would have went to Uncle Sam that is now in my bank account instead. And so this tool, like I had mentioned, it just kind of walks you through what does this short-term rental do for me from a tax savings perspective. I will call out, though, these assumptions. If you look at the bottom here, it's based on 15% land allocation and 25% bonus depreciation. So depending on the area you're buying in, like if you're buying in a Florida or a California, your land might be worth more, so you have to discount this formula. But this is a great tool to kind of get you guys started, because it'll help you analyze your deals as well as show you the tax benefits here. And that's it for today's show, guys. We talked about not only using the short-term rental loophole to help you accelerate and build your short-term rental journey, but we talked about the other sort of creative strategies, what to look for in a property when you're buying for tax benefits. And we talked about what are some of the other cool things that you can do once you've implemented this strategy, because the cash flow that you're producing this year, the next year from the tax savings is minimal compared to the hundreds of thousands of dollars that you could be saving by converting some of your accounts over to Roth or contributing to Roth. Those things are so important, and I don't think anybody has ever mentioned the other strategies that you can do when it comes to short-term rentals. So thanks for tuning in to today's show. If you like it, make sure you give me a review wherever you're watching this, whether that's Spotify, Apple Music, YouTube, and let me know what you'd like to see on the next episode. Thanks, guys.